Hello, very good morning to all, and welcome back to today's Daily Dose of Market Insights. I'm Kelvin here again. Welcome back to today's Daily Dose of Market Insights. I hope that you guys have a great weekend and a restful weekend. So today we have pretty much ground to cover of what has taken shape on last Friday. So before we kickstart on today's Daily Dose, today will be Monday, the 4th of August, 2025, a brand new trading week. And before we kickstart our daily dose, let's have a quick look at the disclaimer slide first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump straight into the gist of today's daily dose, which is the intraday technical outlook on the 4 major US dollar pair, the 6 major stock indices, the 2 key commodities, gold XAU/USD. Let's have a recap what has taken shape on last Friday and also any important news flow that happen over the weekend that has a potential impact on the intraday movement on all these broad-based cross asset classes. So last Friday, important data was the non-farm payroll data. So the release of this non-farm payroll data caused a lot of near-jerk reaction to the global markets. So what do I mean by this? So what we could see over here is that the dollar strengthened. So before we go into the dollar strengthening and the sell-off in the major US stock indices, and the push up in gold XAU/USD, let's have a quick look what causes or what reinforced this rather erratic intermarket intraday movement on last Friday. So it was this non-farm payroll data over here that came in below expectation. One thing to note that even though yes, it came in below expectation, the prior 2 months of data release for the non-farm payroll data for the month of June and as well as for the month of May was revised downwards significantly as well below the 100K handle level. So what do I mean by this? Firstly, let's look at the July figure. So the July figure came in at 73K jobs added, way below 110K jobs added. But however, the prior 2 months of June data has been revised downwards significantly as well. Previously, it was at 147K. It was reduced to 14K. So what do I mean by this? So if you go to the data over here, if you look at for the previous month of May and June, it was starkly way below revision. It was revised downwards way below that was the previous print of 100 over K handled in the previous month of May and June. So if you look at it over here is that the June figure was sharply revised downwards from an initial 147K to just 14K, and the May reading was also cut by 125K. So if you look at this past 3 months of data, May, June, July, they actually came in below the 100K handle. All right, and so far the only non-farm payroll data on a monthly basis that came in below the 100K handle was in the month of October 2024. Previously it was at 44K. So what we could see over here is that in the last 3 months, the job market has started to indeed turn soft in the US economy. Also, despite the fact that the the unemployment rate continued to hold steady at 4.2, also inch up slightly higher to 4.2% from 4.1% that was printed in the month of June previously, and came in within expectation of 4.2%. So with an inch up slightly higher unemployment rate and the disastrous print of the labor market, the headline non-farm payroll data that grew remarkably lower from the month of July, and the previous month of June and May previous print was revised significantly downwards as well. That potentially indicate that the US economy, especially the labor market, has started to turn soft, and that potentially bring back the interest rate cut hopes alive for the next month of the September meeting. So still recall that previously in the month of September, after the FOMC meeting not too long ago, which was last week, the Fed was especially Fed Chair Powell was stubbornly reluctant to commit to a September cut, and the odds of a September cut prior to the FOMC meeting last week, it was over 60%. Then it was greatly reduced to about 40%. And after the rather disastrous non-farm payroll on Friday, the interest rate cut for the September meeting, which is on the 17th of September, has jumped up significantly to 81% as portrayed by the market expectation, by the trading behavior of the Fed Funds futures traders in the Fed Funds futures contract, as being compiled by the CME Fed Watch 2. So the Fed Funds futures trader now is assigning a high odds of 81% that the Fed may cut in September, greatly increased by 40% prior to the release of the non-farm payroll data on Friday. So market now is signing one interest rate cut to be alive coming into the 17th of September meeting. And also, if you look at the aggregated tab over here, the next interest rate cut after the 17th of September, as portrayed by the latest price action of the Fed Funds futures traders, assigning a high probability of 81%. They also assign a rather high probability that 50, not really that high, but slightly above 50%, 54% that the Fed will do a second consecutive rate cut on the 29th of October meeting. All right, this year potentially. If they don't cut on the 29th of October, there could be a higher chance of 69% that the Fed will engineer the potential second rate cut before 2025 ends, which is on the 10th of December 2025, bringing the Fed funds rate to 3.75% to 4%. So now market is now has been in line with the thinking of the Federal Reserve officials in the previous dot plot that was released in somewhere around June, where they pencil in potentially two interest rate cuts. So that actually reduced the previous so-called not so dovish guidance as portrayed by Fed Chair Powell in last week FOMC meeting before that disastrous non-farm payroll data print. And on top of this non-farm payroll data print, we also start to see the US manufacturing activities that continues to be in a month of contraction in the month of July. So the ISM manufacturing PMI data came in at 48, all right, way below market expecting at 49.5. So this is now on the third consecutive month of contraction over here. Okay, so the ISM manufacturing, so it dipped down from 48 to 40, it dipped down to 48 in July, from 49 in June, slightly increasing the pace of that contraction, missing expectation for an increase to 49.5. So this is the fifth consecutive month of contraction in the manufacturing sector and was the weakest since October last year. All right, so the manufacturing sector in the US continues to slow down. That also created a negative feedback loop to the US dollar as well, even though the manufacturing sector doesn't really contribute significantly to the overall US economy. It's primarily more important on the services sector. So that I'll share with you, the ISM services PMI is actually due this week. All right, so that will be much more of an important data to watch. And if the ISM services manufacturing PMI, if the ISM services PMI for the US, pardon me, disappoint, that could actually reinforce the ongoing dollar weakness that we've seen from last Friday. So what you could see over here is that the dollar weakened significantly. So let me share with you guys, this is the 5-day rolling performance chart of the US dollar over here. Oops, where is it? Okay, so let me push it down, 5-day. All right, so let me change this data to 5th of August, which we are, 4th of August, which we are right now. So the 5-day rolling performance of the US dollar against other major currency as of today, 4th of August. So we know that this is the release of the non-farm payroll data at 8:30 p.m. Singapore time on last Friday. Then after this release, we see a dramatic sell-off in the US dollar, and the dollar sold off the most remarkably against the yen, which is down by negative. At one point, it was down by almost 1% plus, right? Almost 1%, right? So as is today Asia session, there's a slight bounce taking shape, and that initial drastic low of -1 plus, loss has been trimmed to -0.6% over here. So what causes this dollar yen to sell off is because of, you still recall that Bank of Japan in last week meeting, they actually revised up their inflation trend in Japan for the fiscal year of 2025 and fiscal year 2026. So that actually keep the hopes of a potential interest rate cut in Japan by BOJ alive. So we start to see much more higher odds of a monetary policy divergence between the Fed and between the Bank of Japan. We are potentially still looking for normalization their prior decade plus of ultra easy policy and solely increase short-term interest rate in Japan, whereas for US, they are on the brink of shifting to a much more dovish guidance after being on hold for wait and see approach. I mean, refusing to cut rates since the start of this year by the Fed. So there's this policy divergence that come into the forefront of the market again, that causes the dollar yen to plunge significantly on Friday. So if you look at the 1-day rolling performance as we are speaking right now, initially there was a bounce that takes shape in today's Asia session. So after this bounce on the dollar yen, it also starts to dwindle downwards as well. All right, so not showing a clear signs of a dollar rebound coming into the FX picture. And you also start to look at after that earlier bounce at the start of today's Asia session on the dollar from 7 a.m. Singapore time all the way up to the 9:30 a.m. mark. Before the day those start at 11 a.m., the dollar bounce starts to dwindle off as well against other major currency pair like the dollar Swiss, the dollar Euro, the dollar sterling, the dollar Aussie as well. So the dollar Aussie right now is the dollar is actually the weakest on the Aussie right now as we are speaking, based on the 1-day rolling performance basis. So let us touch on the short-term intraday technical outlook on these four major FX dollar FX pair. Right. So if you look at the major US stock indexes, all four of them are definitely closely in the red after that shock over here because of that so-called rather weak labor market. So the S&P 500 is down by negative 1.6%. The Nasdaq down by 1.96%, the Dow Jones down by 1.26%, and the Russell 2000 down by negative 2%. So that was actually we call it after the initial push up at the middle part of last week, where both the S&P and the Nasdaq 100 managed to scale fresh all-time high due to some mega cap technology stocks, rosy guardians, and upbeat Q2 earnings announcement, especially with the likes of Meta as well and Microsoft. All right, that causes the SPX and Nasdaq to scale new fresh all-time high last week. But towards the end of the last Friday, it dwindled downwards. So what's interesting over here is that the way the sell-off actually didn't break below the 50-day moving average on the S&P 500 and the Nasdaq 100. Yes, it broke below the 20, but it managed to held above some key short-term interim support level that later I'll share with you guys when I cover the intraday technical outlook on the SPX, the Nasdaq 100, and as well as the US Wall Street 30 that represent the Dow Jones Industrial Average over here. There, on Friday, we will see a remarkable recovery on gold as well, given riding on the coattails of a weak dollar. So we know that gold has been a very choppy in the last few weeks, not weeks, even for the last 1.5 months or so over here. So let me share with you what do I mean by that. So if you look at the trend of the gold over here, okay, so this is a daily chart of gold. Right, so if you look at the trend of gold since printing its fresh all-time high on 22nd of April, in the last 3 months or so, yeah, almost close to 3 months, we see gold in a rather whipsaw sideways range configuration. All right, over here, ding-donging, it's a very messy, notorious sideways range. All right, so previously, the psychological level 3,300 was taken down on exposed FOMC on the 30th of July. That afterwards it managed to recover on last Friday by having a very strong Marubozu candlestick price action that closed above the 20 and the 50-day moving average again. So what we could see over here is that previously the break below 3,300 is a failure breakdown, And what we could see now is that at least the bulls gaining some traction. But however, in order to really clear above this sideways range configuration, the bull got to break above this previous medium term peaks of 6th of May, 13th of June, and as well most recently on the 23rd of July, not too long ago. So that's about 2 weeks ago that it failed to break above it for the 3 times at 3,435. So unless we have a proper clearance above 3,435, then we have a much more substantial bullish impulsive upmove sequence coming back into the market of gold. So or else other than that, we may start to chop around this vicious sideways range again. All right, over here. So that's for gold movement. And over the weekend, right, what we have over here is that on Sunday we have the OPEC Plus meeting. So the OPEC Plus meeting, you know that since the start of this year they have been continuously increasing production heights over here. That means increased production by OPEC members to more this more likely due to political pressure from the US, where US actually wanted to have a lower oil price to allow the White House administration to administer their policy that tends to be inflationary in nature. All right, so it's trying to actually have a net off effect, a reduction in corporate tax cut will increase the budget deficit significantly in the US, and that will actually see inflation pressure coming in, and as well as Trump's White House latest tariff policy. Yes, it has been more or less settled with a reduction tariff rate, but that's for country basis. And we have a slew of sectorial product-based tariffs that are still coming into the picture, especially pharmaceutical, semiconductor that has yet to be decided on the final amount. So that will apply through goods. Whatever country that's producing pharmaceutical goods heading into the US, whatever country that is producing semiconductor chips or whatever stuff heading to the US will have a universal higher rates on top of the country specific rates of tariff rates. So that is also inflationary in nature. And to offset some of this inflationary pressure, in the couple of months ago, there have been a lot of dialogue between US and OPEC key members like Saudi Arabia. So potentially this ongoing OPEC plus production increase or production high is more or less due to US pressure to on OPEC plus to keep a cap on oil prices, all right, coming up from the Middle East. So OPEC plus will shortly hike production again in September to finish unwinding its latest strategy of supply cuts in a push for market share, but left the question mark hanging over its future options as global markets face a mounting surplus, right? Because there's a lot of supply going onto the market right now. So Saudi Arabia and its members agreed on a video conference to add another 457k barrels a day starting from next month in September. That completes the accelerated reversal of the 2.2 million barrel cutback made by 8 members in 2023, and also includes an extra allowance being phased in by UAE over here. So because of this continued increase in production output heights, that also causes the West Texas crude oil to plummet in today's Asia session as well. So if you look at the daily chart, where is the daily chart? Yeah, the daily chart over here. So on last Friday, oil price plummeted by negative 3.10% in line with the rather weak 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 non-farm payroll data. And at the start of today's Asia session, it also extended this drop by negative 0.23% on the news flow of that increased production height, additional production height by OPEC Plus member that has been kind of being officially announced on last Friday over here. All right, give me a minute. Okay. All right, so now that potentially sum up the first segment of today's daily dose of market insights. So now let us now proceed to the second segment of the daily dose, which is the intraday technical outlook on all those major cross asset classes. All right, so before I kickstart that, let me expand my screen so that you guys could have a better view of the charts over here. All right, great. So let us start with the FX market over here. So over the FX market, if you still recall, on last Friday, we flipped to a bullish bias on the euro dollar, holding at the key short-term pivotal support at 114 figure, and it has already made the push up as intended and hit the 50-day moving average, which as our 115.70 second resistance level. All right, so it's already hit that intended resistance on last Friday, fulfilling that bullish bias scenario that we have on Friday. So with this bullish bias scenario has been fulfilled, let us now take a look at the new elements that is forming on the hourly chart of the euro dollar. So bear in mind that this is an intraday technical outlook that is only very lasting for, the aim is to lasting for about a day or so, and the next outlook will be revised again when we kickstart our daily dose tomorrow. All right, so what I could see is that that push up starts to form a higher low at the 50-day moving average, but can't have a proper bullish breakout above it, and starts to pull back in today's Asia session. So during this pullback that it start to shape after hitting that 50-day moving average, the hourly RSI has starts to shape a bearish divergence. So there's this opposite movement by the raw price action where it show higher high at the 50-day moving average before it retrace downwards, but the RSI starts to print a lower high and exit from the overbought level. So this represent a sign of intraday bearish momentum that is winding down. That means intraday weakness that starts to seen on the euro dollar. So there could be a chance that there could be some form of retracement taking shape for the euro dollar in today's session over here. So with that, I have the lack of confidence to remain a bullish bias for today. So instead, I will flip to a intraday neutrality stance between 115.20, which is the minor swing low that was formed on last Friday before the push up towards the last 3 hours of the US session on last Friday. So neutral between 116 figure level and 115.25. Only a bullish breakout above 116 figure level will continue the impulsive upmove sequence on the intraday basis. In first step, revisiting 116.40, the next intermediate resistance to watch, which is corresponding to the downward sloping 20-day moving average. A break above it exposes 116.80, 117.05 next, which also confluence with the former medium-term ascending channel from the low of 13th of May. And if you do the Fibo retracement, right, of that previous sell-off from 24th of July all the way down to last Friday intraday low, that also confluence or coincide closely with the 76.4% Fibo retracement as well. All right, so next up will be the sterling dollar over here. So the sterling dollar last Friday we were neutral because the elements is not as great as the euro dollar. So the neutrality range managed to break out on the upside at 132.10 level. And what's interesting over here is that the hourly RSI also broke out a former parallel ascending trend line resistance, retested it, the pullback support on last Friday at 2 a.m. Singapore time, or 2 a.m. Singapore Saturday time, and managed to stage a bounce and form a higher low so far. And interestingly, right now, the hourly RSI hasn't hit the overbought level yet, whereas the euro dollar RSI has formed a bearish divergence right below the overbought level. Okay, so with that, we have much more confidence to flip to a intraday bullish stance on the sterling dollar for today. All right, so using 1.30, using 1. Give me a minute, sorry about that. Okay, using 1.3210 as my short-term pivotal support level. First resistance level to watch will be 133.15. A breakout above it exposes 133.80/134.10, which is the confluencing with the very close to the downward sloping 20-day moving average, and as well as this former minor ascending trend line support level now turns into a pullback resistance, where I previously drew from the former minor swing low of 16th of July and 17th of July. Only a bearish breakdown and the hourly close below 132.10 pivotal, short-term pivotal support that I have for the sterling dollar for today, that would invalidate my bullish bias on the sterling dollar to see it retesting last Friday minor swing low before the release of the non-farm payroll data at 131.70/131.40. That's for the sterling dollar. Up next will be the Aussie dollar. So Aussie dollar, we were also neutral on last Friday because of that earlier bullish divergence that was being formed doesn't allow me to have a very strong conviction to play down towards the 200-day moving average, and indeed it starts to actually tested the lower neutrality limit at 64.20 before shaving a rebound over here. And what we could see over here is that the hourly RSI also, after shaping that bullish divergence, it also did that bullish breakout from that former parallel descending trend line, now turns into a pullback support on last Friday on Saturday 3 a.m. Singapore time, which is last Friday US session, and continues to print a series of higher low above the 50 level mark, indicating that short-term intraday bullish momentum still remains intact. So for sure, 64.20 will be my short-term pivotal support level that I have for today. For a minor pullback that may take shape during the European session, so I do keep a close watch on 64.55 level over here, which is the meeting line that is being formed during the close of the US session and the start of today's Asia session. All right, so this will be the first support level to watch just in case of any minor pullback during the start of the European session. As long as this pullback didn't surpass 64.20, we will flip to a intraday bullish bias on the Aussie dollar for today. Next resistance level to watch will be 65 figure level, which is pretty much close to the 50-day moving average. Above it exposes 65.40, 65.50, which is the congestion area of 18th of July to 28th of July. And also, if you do the Fibo retracement of that last sell-off from 24th of July intraday high all the way down to last Friday intraday low, that also constitute with the golden ratio of 61.8%. However, if price action starts to break down below 64.20, today's intraday bullish bias will be invalidated to see a further slide to retest the key 200-day moving average and its sideways range, the medium-term sideways range configuration support level, linking from the lows of 24th of April and 23rd of June, now acting as the key range support, medium-term range support area or zone that confluence with the 200-day moving average at 64 figures slash 63.90. Right, so that's for the Aussie dollar, flipping to an intraday bullish bias using 64.20 as my short-term pivotal support level. Onward next will be the dollar yen. So with dollar yen, on last Thursday Expo's BOJ meeting, there was this push up over here. So this push up over here initially cleared above the 200-day moving average, and so break out above this complex ascending range configuration from the low of 22nd of April. But however, last Friday, bearish Marubozu price action totally eradicate the bullishness of that push up, and also indicate that the push up on 31st of July is a failure bullish breakout, or it's a failure bullish breakout over here, where price action shaped a very clear significant bearish reaction on last Friday, which is a Marubozu candlestick that actually covers almost 1, 2, 3, 4, the 4 day of previous price up mover, kick starting from Monday last week. All right, over here. So what you could see is that last week entire rally at from Monday to Thursday has been totally wiped out by this black daily Marubozu black bearish daily Marubozu candlestick on the dollar yen that took shape on that formed on last Friday, due to reinforced by that very disastrous and weak non-farm payroll data that also got revised downwards in the prior month of June and as well as May. So what you could see is that a failure bullish breakout on last Thursday for the dollar yen. So that also causes the dollar yen on the hourly chart time frame to actually be in a deeply oversold territory right now. So being deeply oversold right now, there could be a chance of a minor bounce as we head into the European session thereafter. So as long as this minor bounce didn't surpass above 48.75, short-term pivotal resistance that I have for today. So if we do that sell off on last Friday all the way down to today's Asia session intraday low, that also confirms very closely to the 50% in between 50% Fibo retracement and 38.2% Fibo retracement over here. So flipping to a bearish bias for today on the dollar yen using 148.75 as my short-term pivotal resistance level, in any case of any minor bounce that may take shape, as well as because of the grossly oversold level that has been that is being seen now after last Friday's steep sell off. So after as long as 48.75 holds, short-term pivotal resistance holds for any of these bounces. The next support level to watch will be 14680, followed by 14585, which is the minor swing low of 24th of July, 24th of July, pardon me, that confluence with the 50-day moving average. Only a bullish breakout above 14875 will see a prop again at the 200-day moving average at 14950 level. All right, so put it writing 14950. Right, so that's for the dollar yen. Flipping to a bearish bias in any bounces that may take shape using 14875 as my short-term pivotal resistance level. All right, so that sum up the intraday technical outlook on the major 4 US dollar pair. So now let us now focus our attention to the major stock indices, starting with the Hong Kong 33, representing the Hang Seng Index. So the Hong Kong 33 managed to actually shape a gap up after last Friday US session sell-off, and the gap up managed to survive right exactly at the short-term pivotal, at the 50-day moving average, and as well as this lower boundary of this medium-term channel that I drew from the low of 2nd of June over here. So with that strong bounce that's being seen, and also that bullish divergence that was being formed on last Friday US session and today's Asia session bullish breakout of that former parallel descending trend line resistance indicate the return of at least a short-term intraday bullish momentum condition on the Hong Kong 33 index, which represent the Hang Seng Index over here. So with that, we'll be watching 24,140, which is the 50-day moving average, and as well as the lower limit of this medium-term ascending channel that I drew from the 2nd of June low. 24,140 will be my short-term pivotal support level for today. We do have a bullish bias on the Hong Kong 33. First resistance level to watch will be last Friday US session high at 24,790 slash 24,890. We saw confluence with the 20-day moving average. A break above 24,890 will allow the bulls to gain more traction to expose the next intermediate resistance level at 25,220. Only a bearish breakdown below 24,140 and the hourly close below it will invalidate today's intraday bullish bias to see the extension of the corrective decline, exposing the next intermediate support level at 23,680, which is the minor swing low of 4th of July and 7th of July. A breakdown below it sees 23,260 slash 23,110, which is the minor swing low area of 20th of June, 23rd of June, and as well as 20th of June. Right, so that's for the Hong Kong 33. Next up will be the Japan 225, representing the Nikkei 225. So the Japan 225 also managed to shape a bullish divergence as well in today's Asia session, as price action managed to reintegrate back above this medium-term ascending channel that I drew from the low of 23rd of May over here after a test of it or challenge of it on last Friday. So given this push up over here, and also now attempting to recapture above the 20-day moving average, at this point in time as we are speaking, we will be using 39,740 as my short-term pivotal support level, and given the fact that the downside momentum has started to ease off from last Friday's sell-off and the reintegration back above the medium-term ascending trend line that I drew from the month of middle of May this year, that indicate that last Friday selling pressure has started to ease off as well. So with that, we would have a bullish, with that we will have a bullish bias on the Japan 225 for today over here, using the 39,740 as my pivotal support level. First resistance level to watch will be 40,600 next over here. Okay, a breakout above 40,600 potentially exposes this 41,285 next. However, if price action starts to break down below 39,740, today's intraday bullish bias will be invalidated to see the extension of the corrective decline sequence downwards, exposing the next near-term support level at 39,455, which is the minus swing low of 22nd of July and pretty much close to the 250-day moving average as well. a breakdown below it exposes the medium-term pivotal support at 38,940, which is being defined by the former range resistance from May 2025, now turns into a critical medium-term pullback support area at 38,940. So that's for the Japan 225, using 39,740 to have a bullish bias for today. Next up will be the Germany 30, representing the German DAX. So the Germany 30 and has a bearish breakdown below this sideways range configuration that was formed from the current all-time high of 10th of July. And from there, it tries to trade for the entire 3.5 weeks in a sideways range before breaking down on last Friday. What we could see here, close to about 4 weeks of, I would say, close to coming close to the 3.5 weeks of range configuration for the Germany 30. So there was a bearish breakdown, and there's no bullish divergence that's being formed so far. It's only with the hourly RSI exiting from an oversold region as we are speaking right now. So with this exit from this oversold region, there could be some bounces taking shape during the start of the European session today. So we'll flip to a neutrality stance between 23,930, which is the former range support level, now turns into a critical pullback resistance. So neutral between 23,930 and 23,930 and 23,390 for the Germany 30. Next up will be the major US stock indices, starting with the US Wall Street 30 that represents the Dow Jones Industrial Average. So Dow Jones Industrial managed to actually hit our pivotal support area, do a bit of challenge, and whipsaw it before recovering above 43,600. So 43,600 was my short-term pivotal support level. It did a bit of excess with an intraday swing low area at 43,475. And after the excess that is being made, it managed to recapture above 43,600, and it's now trading at 43,732. And the way it actually bounced, it also bounces off exactly at the rising 50-day moving average that has been price action has started to trade above it since 8th of May this year. All right. And also what's interesting with that bounce off the 50-day moving average, the hourly RSI has managed to trace out a bullish divergence over here as we are speaking. So with that bullish divergence that's being formed and a bounce off the pivotal support level after a challenge at 43,600, slightly lower, there could be some signs of bullish momentum coming back into the US Wall Street 30. So with that, I will still maintain that bullish bias with a bit of excess at 475. So 43,600 slash 43,475, that will be my excess short-term pivotal support that I have for today. Bullish bias for the US Wall Street 30, representing the Dow Jones Industrial Average, but I will have a slightly adjusted resistance level to watch today. First resistance level will be 43,920, which was the former minor swing low of 16th of June. That got rejected by the bulls on last Friday after the release of the non-farm payroll data. A breakout above 43,920 will allow the bulls to gain more traction on the intraday basis to expose the next intermediate resistance zone at 44,250, 44,390, which confluence with the 20-day moving average as well. Only a bearish breakdown below 43,475 that will invalidate today's intraday bullish bias to see the extension of the corrective decline sequence moving downwards for the next intermediate support level to come in at 43,170 and 42,860, which confluence with the 200-day moving average, and as well as this ascending trend line support from the low of 23rd of May. So that's for the US Wall Street 30. Next up will be the S&P 500. So the S&P 500 also inched downwards and broke our short-term type pivotal support level at around the 6,280 level mark, 6,290 mark, and sell off all the way down and hit the lower limit of this medium-term ascending channel, this turquoise green line that I drew from the low of 23rd of May this year. All right. And upon hitting that medium-term support level or medium-term ascending channel support level, the hourly RSI also managed to shape a bullish divergence as well as price action shaped a lower low on last Friday sell-off. So this indicating that the return of a potential short intraday bullish momentum condition coming into the the S&P 500. So with that, I'll be using 6,227 as my short-term pivotal support level to maintain a intraday bullish bias for today, first resistance level to watch will be last Friday sell-off high level upon the release of the non-farm payroll data, and so confluence with the 20-day moving average as well. 6,290/6,305. A breakout above 6,305 will allow the bulls to gain more traction to seek out the next intermediate resistance zone at 6,330, followed by 6,348 next. However, if price action starts to have a bearish breakdown below 6,227, today's intraday bullish bias will be invalidated to see the extension of the corrective decline sequence, exposing the next near-term support level at 6,187, followed by 6,140, which also confluence which is the minor swing low of 27th of June. That also confluence with the rising 50-day moving average. Next up will be the Nasdaq 100. So Nasdaq 100 also faced a similar sell-off on last Friday, breaking below the 23,100 handle short-term Titan short-term pivotal support level, but managed to actually stop at the medium-term ascending channel support that I drew from the low of 23rd of May. So given that it managed to find some form of support and U-turn at the medium-term ascending channel, and this U-turn on the medium-term ascending channel support managed to actually seek a bullish divergence condition that's being printed out on the hourly RSI that indicates some form of short-term bullish momentum condition that starts to creep back for the Nasdaq 100. So with that, we will have a bullish bias for today using 22,650 as my short-term pivotal support level, which is the minor swing low area of 8th of July and 14th of July. First resistance level to watch will be 23,020, which is last Friday minus sell-off area, which is a confluence with the 20-day moving average, acting as the intermediate resistance level right now. A push up above this 23,020 level may seek out a further a push to revisit the next intermediate resistance at 23,313. Only a bearish breakdown below 22,650 that will invalidate today's intraday bullish bias to see a dip down towards the next support level that may expose the 50-day moving average as well, confluencing at a similar level at 22,387. All right, so that's for the Nasdaq 100, and also sum up the intraday technical outlook on all the 6 major stock indices. Now let us focus on the commodities market, starting with gold XAU/USD. So for gold XAU/USD managed to actually break out above our short-term pivotal resistance level that we have on Friday at 3,310, and starts to inch higher, holding above the clearing above the 20 and the 50-day moving average. So it seems to me that it's now moving up towards the upper limit of that complex sideways range configuration that has been in place since the fresh all-time high that was printed in April, 22nd of April this year. So with that, potentially my first support level to look out for will be at this 3,334 level over here. So given that it starts to actually form a hourly bullish dragonfly doji at the start of 9 a.m. mark in today's Asia session, and also holding above the 20 and the 50-day moving average. So I would actually have a pivotal support area around here. Give me a minute. All right, 3,334. Okay, 1 second. Let me adjust it. All right, 3,334. That will be my short-term pivotal support level. 3,334. Next resistance level to watch will be 3,378. A breakout above it exposes 3,439, followed by 3,447, which is the swing high area of 23rd of July and the swing high area of 13th of June over here. Okay. However, a breakdown below 3,334 short-term pivotal support for gold that will invalidate my intraday bullish bias for the push up towards the upper limit of this complex medium-term sideways range, and see it drifting downwards towards the next support level at 3,310. All right, so only a breakdown below 3,310 may see a further extension to revisit the lower limit of this complex sideways range configuration at 32.64, followed by 32.75, which is the exact minor swing low of 30th of June. All right, so that's for gold XAU/USD, flipping to a bullish bias for today, given last Friday rather significant positive price action, using a tightened short-term pivotal support to watch out for 3,334 for gold for today at XAU/USD. Now, lastly will be the West Texas crude oil over here. So for the West Texas crude oil, what we could see is that it broke down again below the 200-day moving average over here. So, and also at this former minor swing low area now turns into a pullback resistance at former minor swing low area of 30th of July and 1st of August now turns into a pullback resistance at 69.15 level. All right, so let me put it. Okay, so using 68.50, 69.15 as my short-term pivotal resistance zone for today. So for West Texas oil, we will flip to a bearish bias, break down below 67.30, which managed to find an intermediate support right now, which is the 50-day moving average, and this minor congestion area of 28th of July and 29th of July. Potentially, it may revisit the swing low area of this 25th of July. Okay, give me put it in writing. All right, at 65.95/65.92, 65.95/65.20. All right, 65.95/65.20. So 65.20 is very important. It's the 25th of June complex sideways range configuration support. All right, so that's for West Texas oil. However, if you start to see a breakout above 69.15, upper limit of that short-term pivotal resistance zone, then today's bearish bias will be invalidated to see a squeeze up to revisit last Thursday minor swing high area at 71.20. All right, so flipping to a bearish bias for today for West Texas oil, using 68.50/69.15 for it to potentially float down towards the lower limit of this complex sideways range configuration that is in place since 25th of June. Right, that's also sum up the intraday technical outlook on all the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today's? All right, so today will be Monday, 4th of August. So today will be a rather quiet session in terms of the European market, and as well as the US market. There's no US federal official speaking for today, and today data will be more centered on the Q2 US earnings over here. So in today's Q2 US earnings session, after the close of today's US session, that means at 5 a.m. After 4 a.m. Singapore time today, which is the 5th of August, Tuesday, Palantir Technologies will report their Q2 earnings. So we know that Palantir Technologies has been one of the outperformer in the Nasdaq 100 and the S&P 500. So that could potentially create a feedback loop into the price movement of the S&P and the Nasdaq 100 when trading when in tomorrow's Asia session trading after the release of their Q2 earnings, which is after 4 a.m. Singapore time tomorrow, 5th of August. All right, so that will be Palantir Technologies. So that sum up today's Daily Dose of Market Insights. I'm Kelvin here, signing off. I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.